Google has been one of the most hated stocks in all of 2025. Narratives like the death of Google search and ChatGPT taking over have painted the picture of a company losing its grip. But in this video, we're going to cut through the noise and put those claims to the test. Are they true, or is Google still one of the best long-term investments out there? And to find out, we'll break down Google's business model piece by piece, look at their financials, and then run a valuation model to see what price actually makes sense for the stock to buy. But before we start, this video is not financial advice, so please do your own research. Seriously, if you buy a company just because someone tells you to buy it, it almost always ends up in a disaster. Because if the stock drops, you won't have enough conviction to buy more of it, and if the stock rises, then you also likely won't have the conviction to hold it. And that's why you need to have your own conviction. When most people think of Google, they usually are thinking of just Google search. And although yes, Google search does make up the majority of Google's revenue, over the last 10 years, they've really diversified and they've done a darn good job at it. We're going to break down each of these segments and we'll deep dive on the segments that I think are interesting. So like I said, the biggest share is Google search at 57%. Next is Google Cloud, which is their fastest growing segment by a mile. And it's also turning profitable, and so we'll definitely deep dive on Google Cloud. Next is Google subscriptions, platforms, and devices. This is more of a boring segment, so we won't deep dive too much on it. Next is YouTube ads, which I think is a very interesting segment, and finally Google Network, which is also an ad segment, but it's the ads you see that are outside of the Google products. So we also won't touch too much on that because it is a boring segment. So let's start off with Google search. I'll head over to fiscal.ai here, and let's first look at Google search revenues and Google search revenues' growth. So over the last, let's say, call it 2 years, we've seen around 10 to 12% revenue growth. ChatGPT has really gained popularity ever since 2023. So, I mean, the numbers you're seeing here are way past ChatGPT's introduction and ChatGPT's growth. So what I see here is even though I think ChatGPT is a phenomenal product and LLMs in general are phenomenal products, it's clear to me that they're not really disrupting the search market. I mean, if they were gonna disrupt the Google search, then we would have already seen this by now, right? I mean, ChatGPT has been out, like I said, again, for almost 3 years now, and we're still seeing 10, 12%, 13% revenue growth in Google search. So, I mean, listen, the narrative of Google search dying, I think was happening when Google was trading at $150 a share, but now we're trading at $200 a share. No one's really talking about that anymore. I mean, people only talk about bad narratives when stock's trading at lows, and when it's trading at highs, they kind of just forget all about it. And so, I mean, just looking at the numbers, you can tell Google search is not a dying business. It's still growing at 10, 11, 12%, 13% per year. And next, I want to touch on Google Gemini, which is Google's version of ChatGPT. It's their LLM, right? And although ChatGPT did have a massive first mover advantage, and that's kind of what allowed them to have this meteoric growth, Gemini is quickly catching up. And the reason why Gemini is catching up is because Google already has billions of users that are using all their other products, right? I mean, think of YouTube, think of Google Search, think of Gmail, think of all the Android devices, the Pixel devices. All of that makes it so easy for Gemini to kind of just integrate their product into all of these other services, right? Like, I mean, right now, if you do Google Search, most queries already have some sort of AI response at the very top of it. That's how easy it is for Google to integrate Gemini into their products. And I can see the same thing happening with YouTube, Gmail, and their Android phones, and all the other products and services that Google already has billions of users. And this is why it makes it so easy for Gemini to quickly catch up to ChatGPT. And we're actually seeing this. In terms of traffic, we're seeing explosive growth in Google Gemini compared to ChatGPT. It's growing in terms of traffic. It's growing almost 3 times as fast in the most recent, 6 months, call it. And we're also seeing the same thing when it comes to app downloads. And this is specifically on Android devices. It's growing almost 4 times as fast as ChatGPT, specifically on Android devices, because it's so much easier for Google to push Gemini on devices that are Android. So it kind of makes sense. But the point I'm trying to make here is that even ChatGPT has been out for 2-3 years, and we haven't seen Google search get disrupted. We're still seeing consistent growth, 10 to 13%, and I don't see that changing anytime soon. Next thing I want to talk about is Google Cloud. So first, let's go over back to fiscal.ai and let's look at Google Cloud's revenue growth. So right over here and right over here. So over the last 6 quarters, we're seeing revenue growth actually pick back up, which is insane. I mean, in 2024, we were seeing 26, 27% revenue growth, but in the most recent 3 quarters, we saw 30, 30, and 31% revenue growth. That means that, in fact, Google Cloud's revenue growth is accelerating, which is insane. Like for a business growing already so quickly, to see it accelerate even beyond 26% to 30 and 31%, that's insane. And in fact, even though it is the third place in terms of market share, we're quickly seeing it catch up. In 2025, Google Cloud was the fastest growing major cloud provider. I mean, that's super impressive. And the good news is that Google Cloud is turning profitable, right? I mean, Google Cloud has been unprofitable for like 10 years now, but it's slowly turning profitable. And at scale, cloud is a super profitable business, almost as profitable as the ad business. So so this is one of the reasons why I think Google is going to have increasing margins over the next few years. Because again, over the last 10 years, cloud was not a profitable segment for them. But now things are changing. And so we'll talk about margin expansion in a bit, but I want you to keep note of that. The third business I want to talk about is Google subscriptions, platforms, and devices. Now, like I said, this is a boring segment, but the one thing I want to point out is YouTube Premium. YouTube Premium, if you guys don't know, is a premium subscription you pay on YouTube so that you won't see ads anymore. Right over here, we see that YouTube has monthly active users of almost more than 3 billion people. So to put that into context, more than half the globe, basically, or a little less than half the globe, is using YouTube on a monthly basis. I mean, that's insane. And out of those 3 billion people, right now, only 125 million of them are paying for YouTube Premium. Right. And I am a user of YouTube Premium personally, and I think it's a no-brainer. Like every time I go to someone's house and they have YouTube on and I'm seeing ads, I get so surprised. Like, how are you not using YouTube Premium? And I guess I'm someone who uses YouTube a lot, so it kind of makes sense for me. But if you're someone who uses YouTube a lot, it's really a no-brainer. And what I want to point out here is ever since 2020, so in the last 5 years, they went from 30 million to 125 million paid subscribers. That's almost a 5x increase in 5 years. I mean, this shows that YouTube Premium is one of the fastest growing segments of YouTube. Even though it probably makes up such a small percentage of their revenue, it's quickly increasing, and it's such a good way for them to diversify away from, from the ad business. Next thing I want to point out is Waymo. This is, if you guys don't know, this is Google's take on autonomous driving. So this is basically Tesla's by far biggest competitor. And in my opinion, or it's not an opinion actually, Waymo is way ahead of Tesla's robotaxis in terms of actually having cars on the road and actually generating revenue. In 2025, they've already done this. This was in June, I believe. This was actually in January, I believe. They did 700,000 trips in January, and they're expecting to do 250,000 paid trips per week in 2025. So think about that. They're doing 250,000 paid trips per week in 2025. And they're only operating in a few cities. I think it's Austin, Texas, Phoenix, Arizona, and San Francisco and Los Angeles. So they're only in 4 or 5 cities, and they're already doing 250,000 paid trips a week. I mean, think of the fact that robotaxis are just now, I don't even know if they're on the road still. Like, I think they maybe are on the road, but I think humans are still monitoring the trips that they're doing. Waymo is fully autonomous. No one's monitoring them. And I think this is why I think Waymo is way ahead of Tesla. Even though the downside of Waymo is that their cars cost a lot of money. They cost, I think, $200,000 to $250,000 to build each car. But if you know anything about technology and if you know anything about hardware specifically, you know that these costs are always going to come down. I mean, remember the television just 20 years ago, for example. TVs were mad expensive just 20 years ago, and now you can get a TV for like $300. That's because with innovation, hardware costs always go down. And this is exactly what I expect to happen with Waymo over the next 5 years. And the reason why Waymo is such a no-brainer, or autonomous driving, to be fair, is such a no-brainer, is because Waymo has reported 84% fewer airbag deployment crashes in their trips. So I guess they're comparing Waymo trips versus just regular human driver trips when it comes to, like, let's say Uber or Lyft. 73% fewer injuries, and 48% fewer police reported crashes. So, it's clearly way safer than human drivers. And this is based off 22 million miles, which is, but it's not a small amount. It's a big enough sample size to confirm that Waymo drivers are much safer than human drivers. So now that we broke down Google's business model, the next thing I want to look at is their assumptions. So I want to come up with fair assumptions in the future so we can come up with a value for the stock. So the very first thing I want to look at is their balance sheet. Even though the balance sheet won't actually be a part of my valuation model, because I'm going to be doing an earnings per share valuation model, which doesn't take the balance sheet into consideration, but I do want to point something out. They have $450 billion in total assets, and right over here, they have $100 billion in cash. I mean, that's a ton of cash, and that lets them do all kinds of things like paying down debt, which they don't have much debt at all. They only have $25 billion in debt, but it lets them do things like pay down debt, make acquisitions, buy back shares, and that's exactly what they're doing. They're buying back shares, and we'll look at that in just a second. But again, what I want to point out here is that if you subtract assets from liabilities, you get $325 billion in total equity. And I mean, this is not going to be taken into consideration in the valuation model, but it's such a big margin of safety for the stock. So on a per share basis, I just want to show you. So just their balance sheet on its own, without any of their profits, without any of their revenues, their book value per share is $30 per share. I mean, this is insane. This means that, if the company were to stop producing any revenue, any profits today, they would still be worth $30 a share. So this is such an insane margin of safety that I think, is never talked about, but I think it's definitely something to take into consideration. The next thing I wanted to look at here is shares outstanding. So let's just minus these and we'll go to shares outstanding. So if you guys don't know what shares outstanding is, it's the amount of shares the company has. And so a company can either buy back shares or they can dilute shareholders. A company typically buys back shares when they have a bunch of cash and they think their shares are trading at a discount. And that's exactly what Google's been doing since 2021. So since 2021, we can see their shares, they're decreasing, right? And they've been decreasing at a rate of 2.5% per year. So this is going to be super important for us because we will be using this in the valuation model. So that's what I want you to pay attention is Google, since 2021, has been buying back 2.5% of their shares every single year. The next thing I want to look at is their revenue. So right over here and right over here. So their total revenues have been growing at around 10 to 13 to even 14%. So in 2024, they did 14%. And this year, they're on track to do 13% a year. So I also want you guys to take that into consideration because we will be using that to make assumptions into the future. And finally, the last thing I want to look at here is net margins. So we know that they're growing revenue at 13%, but are they growing their profitability metrics? Like, are their margins expanding or are they kind of just staying the same? And we do see kind of a trend here where over the last, let's call it 10 years, they have been growing margins, but not by a crazy amount. So over the last 10 years, they've grown their margins by 3.76% per year. Now, is this good? This is good, but it's not something crazy, but it is something I want to take into consideration when I'm making my my assumptions. So I'm going to open a calculator here. If we're assuming they're going to grow revenue at, so call it 12.5% per year, and they're buying back 2.5% of their shares, and they're increasing their margins by 2.5%, that means we can expect them to grow EPS by 17.5% per year. Now, to be super conservative, I'm gonna assume they're only growing EPS by 15% a year because when you're making valuation models, you always want to be conservative. Like you don't want to be super aggressive and put the best case scenario. You kind of want to be more conservative, just in case things go wrong. You have a margin of safety. So I'm going to open my valuation model right here. And I'm going to teach you guys how to use this. And if you guys want access to this, let me know down in the comments. Make sure to hit like, subscribe to the channel, and let me know down in the comments. And I'll make this free for you guys. Okay, so what you want to do is you want to write down their EPS. So I'll show you guys where to get the EPS from. So you can go to any of these financial websites. Let me just X these out. EPS. So 9.5. So I have it. This is slightly old, I believe. So $9.5 in earnings per share. Okay. Next thing you want to do is you want to assume their EPS growth for the next 5 years. So like I said, I think On the best case scenario, like I said, it's 12.5% revenue growth plus 2.5% shares outstanding plus 2.5% margin expansion. So EPS growth, I think, can be 17.5, but just for the sake of being conservative, we're only going to use 15%. Because again, we don't want to use best case scenarios. We kind of want to use more like worst case scenarios, or at least a base case scenario. And then they're going to ask you to input their PE ratio right now, and they're going to ask you to put the exit PE ratio. So PE ratio right now is, you can literally just, I'll show you guys right here. PE ratio right here. So PE ratio 21.5, so that's where I get it from, 21.5. Now this is very important. This right here is the PE ratio you expect the company to have in 2030. And I'll show you why I came up with 20. And I think, like, I even think this is super conservative. And we'll do more aggressive assumptions in just a bit, but we'll start off with just the conservative assumptions. So for a company growing EPS at 15%, trading at 20 times earnings is super fair. That's slightly over 1 times PEG, which I think is super fair for such a wide moat company like Google. And that's why I choose 20. I mean, right now it's also growing at 15% and it's trading at 21.5. So I'm actually expecting a multiple contraction on a conservative basis. So this is why I think 20 is super fair for a company like Google growing at 15% a year. Okay. So using these assumptions, again, assuming that at 2030 they're going to trade at 20 times PE, and assuming they grow 15% per year for the next 5 years, we can expect a 13.6% return on your investment per year for the next 5 years. Now, I think 13.6% is good, but I usually like to aim for 15% per year. 15% per year for 5 years means you'll get a double in 5 years, which is usually what I like to go for. And in order to get that, in order to get a double in the next 5 years, you should be buying the stock at $191 per share if you assume these assumptions are correct. Now, again, like I said, I'm going to do more aggressive assumptions. So we'll do 17.5 next year, and then 17.5 in 2027, and then we'll assume it'll go like growth will slowly start to taper off and go to 15, 15, 15. So we're assuming 17.5 in 2026, 17.5 in 2027, and then we'll assume growth will taper off. And for exit PE, I'll do 22.5. So again, these are my very aggressive assumptions. So for me, this is best case scenario. And assuming these assumptions play out, we can expect a CAGR, or a return on your investment, of 17% for the next 5 years, which I think is phenomenal for such a safe company like Google. But once again, I do like to assume more conservative assumptions, right? So that's why at these prices, I expect a 13.6% return on your investment. And so I think Google is a buy at $190 a share. So even though I already have a solid position in Google, we have around, I think 10% of my portfolio is in Google right now. And we were buying all the way down in like the 140s, 150s. I think for me to be adding more, it needs to drop below $190 a share. But that doesn't mean I don't think it's a good buy today. I actually do think it's one of the best Magnificent 7 stocks to buy today. I just don't think it's as good as it would be at $190 a share. So I hope you guys enjoyed that. Let me know down in the comments if you guys want this EPS valuation model. And let me know what you think about the video. Make sure to like, subscribe, and do all that fun stuff. Peace.